Hey traders, in this week's video, we're going to be talking about the upcoming US elections along with 3 ways to trade breakout patterns. Hey traders, welcome back. My name is Akil Stokes, Chief Currency Analyst and Head Trading Coach over at TradeEmpowered.com, and thank you for joining me once again for another Forex market preview video. We have a lot to talk about in today's video, but I want to start off by keeping you updated on how our trading has been going. Many of you have reached out to me and said, hey Akil, it has been a rough week. I've just been getting hammered by the markets, and well, I want to let you know you are not alone. I had a pretty disastrous week as well. Maybe disastrous is embellishing a little bit, but it wasn't a profitable week by any means. I started off with a very good winner on the pound dollar and then followed it up with 6 losing trades, 5 or 6 losing trades. I got to check the count. Either way, I didn't win again for the rest of the week. And it's important to let you guys know this, not only for transparency. That's one of the values of being in our syndicate program. You get to see the day in and day out trades of what we do and how we handle it psychologically. So you see the good, you see the bad, and you see the boring, I guess you can say. But I want you guys out there to know that you are not alone. Professional traders do take drawdowns. We do have rough patches. And at the end of the day, they don't really have that big of an imprint on your trading if you've been doing the right things throughout the year. As you can see in front of you, here's an equity curve of our entire year. You can see at the very end, the last few weeks, we've had a few dips. And if you were to only look at and focus on that little bit of time, it may look pretty bad. But when you zoom out and look at the entire picture, it really has zero effect on your trading. Now, I know it's tough to deal with. There aren't really any tricks I know on how to fight through a drawdown other than keep trading your plan and fighting through it. Charles did a great video this week on our Trade Empowered YouTube page on that as well, if you haven't seen it. But one thing I like to do is I like to set myself up, or I like to set my equity curve up on kind of like a projected line. It's industry standard. I've been always told by many professional traders in this industry that if you can average between 2% and 5% a month, now it doesn't mean every month, but you know, when you divide the year down, this is before adding any money management, then you're on set to be a very good trader. Typically, you're considered a good trader if you can be above that 2% line. If you're above that 5% line, you're considered a very exceptional trader. So something I like to do is I like to put on a chart those 2 lines. I like to put my bottom line of 2% where that's at. I like to put my top line of 5% where that's at and kind of see where I'm ranging in between. And as long as I'm anywhere in between those lines, I know there's no need to panic. I'm right on track for where I need to be. Again, I don't have any specific monthly goals, weekly goals, yearly targets as far as profit. My only goal is to continuously and consistently trade the plan. But I do want to make sure I'm on the right track. Another thing for you guys going through drawdowns is you want to make sure you understand what type of drawdown it is. Is it a natural drawdown, meaning that the market just isn't agreeing with your system or strategy, which happens? Or is it a self-induced drawdown? Are you doing something to sabotage your trading? And the latter is what gets most traders in trouble. So a little drawdown talk just to make you feel comfortable. Don't panic as long as it's a natural drawdown. If it is a self-induced drawdown, you may want to take the advice that I gave you in last week's video and just stop trading for the year. Spend these last 6 weeks or so solely focused on education and getting yourself ready to get ready for 2017, I guess you can say. Now, when we head over to the charts, we're going to talk about the U.S. elections a little bit later. But when we head over to the charts, we're going to take a look at the dollar yen and talk a little bit about how to trade breakout patterns. All right, traders. So today we're going to take a look at the dollar yen, and we're going to talk about different ways to approach breakout patterns. However, before we do that, I want to take a brief flashback video at a trade that we took, I think it was about a week ago in our syndicate program, as I think it presents a pretty good lesson on following your plan, sticking to your rules, and not really judging your trading in hindsight. So I'll let that roll for a few minutes, then we'll come back and we'll do some live analysis. Just to review, earlier in the week, I took a trend continuation trade here on the dollar yen. We had broken and closed above our B leg. So if you can imagine this being the B leg of the bigger bat formation, we had a higher high, higher close. Price action then retraced down. We put in a nice double bottom. I bought it up down here and took profits this morning, or this, I guess, late afternoon, early afternoon, late morning, up here for about 63 pips. Now, this is one of the trades we discussed in Monday's Q&A session with our 12-week transformation members. And the question was whether or not to take extended targets. Now, in this scenario, I chose not to take extended targets because although we had a higher high, higher close on my trading time frame, we did not have a higher high, higher close on the higher time frame. So I wasn't necessarily bigger picture thinking an extension of this trend. Now, in the syndicate, it doesn't really matter too much. We always do one in, one out. And what that means is that Charles and I always only take a single target position. But in our personal accounts, we do take multiple targets, meaning a first target and a second target. Just in this particular case, I chose not to get aggressive with that second target and took everything off right here. In hindsight, you're probably saying, oh, Akil, you should have let it ride. But at the end of the day, I just finished up my review for this. It was a good trade. I did everything I was supposed to do. And if I had to go back and do it again, I would do it the exact same way. And that's kind of how you know if you're on the right path of trading or not. Now, price action has created a new higher high, higher close. So what that means. Okay, so as you can see, price never made its way up to that level where I was considering taking second targets, or I guess where I would have put second targets at if we were doing that for that type of trade. And instead, price action retraced all the way back into the B leg, which would have taken me out for break even on the second half of my position. Now, this brings us to an important lesson and not judging your trading in hindsight. If you recall in the video that I just showed you, we had hit first targets, or only targets in this case, and then price action had rallied up another 60 pips or so. And what many traders will do is they'll look at that situation and they'll go, oh, I coulda, shoulda, woulda. I knew I should have taken second targets. I knew I should have done this. I knew I should have done that, because we always like to react, right, in hindsight. After the market has made its move, then we like to say, oh, we should have done this. We would have done that. And what's important is that we stay true to our plan. We stay true to how we're supposed to trade. And like I mentioned, when I looked back on that trade, I said, yeah, it stinks that price action is currently at that level. But as I reviewed everything, I did the right thing. I followed my plan. I traded it how I was supposed to trade it. And a week later, as we come back to the markets, it ends up that it was the right move. As you can see, price action never made it up to our bat formation. We were still looking for an X to A to B, B to C. I think the C to D would have been around here, 106.50s for that second target. We never made it up there. And instead, we came back and passed the level of my original entry. So if I was still involved in the trade, I would have been stopped out for break even on the second half of my position. So you ask yourself this question, you know, in reality, what happened is I took my full position off at about plus 60 pips, right? Where if I woulda, shoulda, coulda, right, broke my rules and did something that I wasn't supposed to do, I only would have achieved half of my position at the 60 pips, and the other half would have been taken out for break even, essentially cutting my profits in half. So a perfect example of how we have rules, why it's important to follow them. Will it always work out this way? No, sometimes the market is going to run and you're going to be left out. But remember, you're trading a specific way for a certain reason. You've done the work, you've back tested. You know that this in the long run, right, consistently time after time after time is going to be the most profitable way to trade. And you don't want to deviate from that due to any one or two trading scenarios. Now, as we go down to our live analysis, let's take a look. Again, we have this big move down here. We have this swing high to swing low coming down here. And as we go down to our lower time frame, you can see that price action has started to consolidate. And what I mean by consolidate is essentially the opposite of this type of move. This is called an impulse leg, a swing high to swing low, a move that is very directional. You see it starts at the top and we end at the bottom. Now, after this move, the market starts to consolidate or coil, meaning we start to trade in a range. Instead of the market going up or going down, it kind of just goes sideways. You can see it gets tighter and tighter and tighter. Now, typically this type of coiling leads to a breakout. Think about it as if you're taking a spring. You're taking a spring in your hand and you're squeezing it, squeezing it, squeezing it, squeezing it. Eventually, you're going to squeeze it as tight as it can go. And when you let go, boom, it's going to explode, or not explode, but pop out and break out. Now, the same thing happens in these markets. So this consolidation leads to expansion. Now, typically in this type, I don't want to go too in depth here, but typically in this type of move, you would expect a breakout to the downside. You typically expect a breakout to come in the same direction as the previous impulse leg. It doesn't always happen. It depends on what type of consolidation pattern you have. There is a difference between rising wedges and falling wedges and ascending triangles and descending triangles. But in general, you would expect a breakout in this direction of the previous move. Now, there are 3 ways to attack this type of breakout, and it all depends on what type of trader you are. One of the things that we do here at Trade Empowered is I don't like to say we teach specific strategies. When I think of specific strategies, I think of like a moving average cross where you trade every time the 13 crosses under the 33, something like that. Really, we teach an overall analysis, an overall skill set of how to read a price chart. And if you have that overall skill set, really, you can do almost anything in these markets. And what's good about that is it allows you to really adapt your trading style to your personality. And for me, that is really, really big. In my opinion, you never want to trade in a way that doesn't meet your overall philosophy of the market. If you don't believe, if you're a trader that says, well, Akil, I know the markets only trend 30% of the time and they consolidate 70% of the time, so I don't really want to be a trend trader. It would be foolish to try and have a trend trading strategy because it goes against what you believe in. You don't really believe that the market's trend. You don't believe in being on that side of the market the majority of the time and taking a lot of losses in order to catch that big move. So every time you enter that trend following type of trade, you're going to be double guessing yourself. Or second guessing yourself. You're going to be thinking of reasons why you shouldn't be in the trade, and that just leads to mistakes. It makes it a lot easier for that self-sabotage to seek in. And that's if you guys have seen the video I did on, it's called Statistics on Why Most Traders Fail. Most traders fail not because they don't know how to trade, but most traders fail because they sabotage themselves. So you want to mesh your trading style with your personality. And what I mean by that is either being super aggressive, being super conservative, or somewhere in the middle. Now, the 3 ways I would look to trade this, and let's go down to an hourly chart and make it a little more clear for you. All right, here's our consolidation. Right, here's our consolidation pattern. Let's say we're looking for a breakout to the downside. That's what we mentioned, right? We're looking for a bearish breakout here. There are 3 ways you can attack this. The most aggressive way is to use a sell stop order. Now, I know most of you guys, when you hear sell stop, you're like, well, Akil, isn't a stop order just for a stop loss? False. That's incorrect. In most cases, it is depending on your trading style. I know most of the ways we trade here, we teach to trade here at Trade Empowered, a stop order is only going to be used for a stop loss. But a stop order can also be used to enter the trade. And you would use a stop order something like this. If you're expecting a breakout to the downside, you're expecting a breakout of this range, you would put a sell stop order below that bottom range. Let's make it green. Right? You would use a sell stop order below this bottom range. And what that means is that if price action were to break out to the downside, you would be filled as the market is going down. So you would be stopped in to a short position. I know it sounds weird, but you would be stopped in to a short position. So that's one way to trade it. That would be for you aggressive breakout traders, is you want to be involved when that breakout is happening. You don't want to have any chances of missing it. You want to get those orders on there. The second type would be a more conservative approach, where instead of having a sell stop order here to catch that original break, you would wait for the breakout. You would wait for the retest, right, of the breakout. So you'd wait for initial breakout, you'd wait for price action to return in the previous structure, and then you would look to get involved right at that retest of structure, very similar to like a normal trend continuation trade. And that's why I don't really like to give these things specific names. They're all essentially the same, right? It's no different from a new structure high an outside return, you buying it up at the outside return, and getting involved in a new structure high. But that would be a more conservative way to approach the market. You wait for the breakout, wait for the retest. That gives you a little bit better entry price instead of being down here. So it allows you to have a smaller or a better risk reward. And then you anticipate that move, that continuation move lower. The third way to handle this would be to enter it at the top of the opposite range. So you see how we have a range right here where the market is coming down. We're bouncing from the lows to the highs, to the lows, to the highs, to the lows, to the highs, right? You wait until we get that bounce to the upper range here. You enter a short position at this range, and then you try to get involved in anticipation of the potential breakout. And again, this gives you it's a little bit more risky because you don't know that the breakout's coming. You don't know which direction the breakout's going to be in. This could easily break out to the upside, and guess what? You're out of luck. But it does allow you to have a smaller stop loss because instead of entering, right? Instead of entering, oops, come on, baby. There we go. Instead of entering here on the retest, you're entering up here. And instead of entering here on the initial breakout, you're entering up here. So you can see that most aggressive way is going to give you a much larger stop loss. Let's just assume your stops are, where we go. Let's assume your stops are up here somewhere. Come on, TradingView, work for me. I'm live. Oh, wrong way. Sorry, guys. Again, this is not my normal platform, but I should be. I use it a lot, so I should be used to it. So let's say your stops are up here above your triangle formation or your wedge pattern here. And let's just say, who cares about where targets are at? You're looking for a breakout to the downside. But here's the difference that you're looking at. You're looking at that initial breakout. And of course, obviously, guys, this is just a generic way of doing it. There are specific techniques that you would want to use to do target placement and stop placement. So don't just, some of you guys are going to look at this and just, oh, Akil put his target down here, so I'm going to take it. Please don't do that. This is just educational purposes. But just to give you an example, an aggressive breakout, you're looking for something like that, right? If you were to take a more conservative approach, let's say on the retest, and again, we want to keep the same target. Zoop. You can see how that risk, right? That risk is much reduced compared to that original one. And then again, on the last one, come on. On the last one, that risk is even smaller. So those are different factors to think about. Now, again, one of the things I mentioned to the clients I work with is that there are pros and cons to everything. So think about it. The cons to this, right? The negative is what I mean by cons. The negative is that you have the most exposed risk if you're taking a technique like this, right? The negative or the positive of this is you have the best risk reward. You have very, very small risk and you have the best reward. However, right? This is your most aggressive way in. So if the market does break straight out, right? The market does come here and just directly go down. Guess what? This trader is involved. These two traders are not. So if you're going to take the more conservative approach, right? You have to deal with the opportunities of, hey, I may miss some trades here. There may be opportunities where the market doesn't give me that retest. The market just aggressively breaks out and I never get involved and I can't be upset over that. And vice versa. If you're going to be the trader that takes that aggressive breakout where you're saying, I'm going to catch every opportunity, you have to deal with the fact that every opportunity also means taking some losses that maybe the other two types of traders never got involved in the first place. And again, it's important to understand there's no better or worse. That's the question I get all the time. Well, which one is the best way to trade it? There is no better and worse. There's pros and cons to all of it. The best way to trade it is the one that meshes with your philosophy, the one that you've back tested, the one that you have a set rule set for, and that you know that when you take it, you're not going to second guess yourself and you're not going to sabotage your trading. That is always the best answer. The US elections, this is what everyone wanted to hear about. I'm going to get into that in a few seconds, but first, I want to tell you about something that we've been doing to raise money for a very good cause. Jason Greystone, former 12-week transformation client, and he is now the moderator and trading coach in our London live trading room. He woke up one day and said, hey, I feel like doing something nice. He wanted to raise money for a good cause. So what he did was he reached out to the Chestnut Treehouse Children's Hospice over in Sussex in the United Kingdom and said, hey, we're going to put together a campaign to raise money and donate clothes, donate toys to the children and family in need. So he gave me a call. I said, hey, Akil, would you be interested? And I said, of course. So I'm signed up with them. Now we have two teams. We have a London team. We have a US team. And what we're doing is throughout the entire month of November, we're trying to run as many miles as possible to raise money for this cause. So I'll shoot you the link underneath this video where you can read about what we're doing. And of course, it'll show you how you can support. But if any of you guys are interested in making a charitable donations, again, the Children's Hospice takes care of children and family with terminal illnesses. And we just want to provide some respite for those families and just... we want to, I don't want to say send them out in style. That sounds horrible, but we want to make life as great as possible for them while they still have a chance to live it. So any type of support, even if it's $5 or anything like that, is welcome and greatly appreciated. Again, you can support by doing that or just sharing whenever we post on social media. Now, U.S. elections coming up this Tuesday, this week, and this has been something that I've been getting questioned about really for the last month. Akil, how are the U.S. elections going to affect the markets? What should I do? What shouldn't I do? And obviously, the honest answer is I don't know. I don't know what the effect is going to be. There are so many theories out there where you could say, well, every time Hillary Clinton shows to be ahead in the polls, the stock market rallies, and every time Trump shows to be ahead, it declines and slides. But I don't know. Here's the key, right? There's a bunch of uncertainty. There's a bunch of uncertainty with who will win. There's a bunch of uncertainty with what will be the effect if either candidate wins. And in general, as a trader, we don't like uncertainty. That's the thing we want to stay away from. Our trading edge is based off consistently executing a specific plan, a specific process. When there's uncertainty, it kind of turns it more into a gamble than it already is. So I would say this: when in doubt, stay out. If you have any concerns about the elections, if you're unsure, if you're fearful, just stay out of the markets. For me personally, the election results, during the day won't make much of a difference. I'll do my normal day trading. I won't deviate from the plan either way. People will just be voting on Tuesday. If you're going to expect any type of movement, that movement is going to come when the results show. And typically the results are going to be released Tuesday evening. So Tuesday evening is I won't be actively day trading the charts. The London session will be over. The New York session will be over. It will be during that thin Asia session where the results get released. And that's typically a time, in my opinion, you don't want to be trading through anyway. We saw what happened a few weeks ago with the pound crash in that same thin market. So if you're going to avoid anything, I would avoid the evening, Tuesday evening. I don't think you need to avoid day trading or anything like that. But again, if you have any fear, if you have any doubts, if you have any concerns, just simply say, hey, you know what? I'm not trading today, or I'm not trading this week. There will be more opportunities. There's no reason to feel like you have to be involved. And in my opinion, there's certainly no reason you want to try and predict the outcome and predict the market's movement based off your predictive outcome. You might as well go to the casino and roll some dice if that's going to be the case. So that's my opinion about the U.S. elections, but we'll see. Again, I'll be trading from them. I'll be trading through it in the live room. I'm sure Charles will be trading through it in the syndicate, and we're just going to approach the markets like we always do. So appreciate you guys joining me again for this video. I will be doing a live event sometime this week. You guys voted on this Forex market preview topic. I put a poll over on Twitter earlier, a couple days ago actually, that said, do you want to hear about breakout patterns or trading flag patterns, or would you rather hear about 20 reasons that traders fail? And about 60% said they wanted to hear about breakouts. But I do want to touch on that topic about 20 reasons. I may dial it down some to 10 reasons why traders fail, and I'll probably do that live here on YouTube at some point this week. I'm thinking about Thursday. I'm not sure if it's going to be on this Trade Empowered FX channel or on my personal channel, Akil Stokes. But if you're subscribed to both, if you pay attention to us on social media, there's no way you can miss the shameless promotion that I will be doing for it. So take care, gang. Also, remember, guys, we did just change our clocks here in the US, so we finally caught up, right? We finally caught up to the rest of the world. So for you guys in the 12-week transformation, our Monday private Q&A session is going to just make sure you check your conversions for that Monday private Q&A sessions. We did just move our clocks back. Same thing with you guys in the live trading room. So until next time, plan your trade, trade your plan, like, share this video, please. And I will see you guys later this week for my live session on 20, 10, 5 reasons, some reasons on why traders fail. Take care.